Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending July 25th, 2025. Before I get going here, next week there will be a review, so we'll be here on August 1st, but then after that the review will be on holiday for the 2 weeks following back on August 22. So it's August 1st and then August 22 for the next editions of the review. So the title of the review this week is Summer Lull. I mean, there's still a lot of things brewing in the background, but the markets are pretty calm. There is nothing that is such a market mover right now, but next week is shaping up to be quite eventful. So we'll see what happens then. But here's the picture of the markets at the close on a Thursday this week. So positive week for bonds, positive week for equities. The biggest performance came from EFI, so Europe and Far East, so that means Japan. We've had a deal with Japan that was announced, a few words on that in a minute, and the market was starting to doubt that any deal was possible, so that was a positive surprise. And we are hearing rumors today that the US and the EU could be close to a deal that would lock in pretty much the status quo, so that would be 15% tariffs on Europe, just the same as Japan got, and 15% seems to be now the floor for any kind of deal. So we're expecting that the next deals that come likely will come with a tag of 15% tariffs as well. We haven't heard anything on the Canadian negotiation this week. July 21st came and went, and no one really mentioned it this much, but we'll see what kind of deal that we get. This week we only heard Mr. Carney say that Canada wouldn't take a bad deal. I mean, you cannot argue with that argument, but let's see what happens as we get closer to August 1st. Oil was down, USD, CAD, well, the CAD was higher. Euro was higher, price of gold consolidating here on its, it's been pretty much stable, well, in a trading range rather than stable since April. We're still up close to 29% on the year here. So an update on tariffs. Again, Trump announced a trade deal with Japan that would see 15% tariffs on all goods. That's a loss for most sectors, but that's a win for auto exports. Autos were tariffed at 25% before, now it's 15%. Interestingly, we're hearing that Europe could be getting also a 15 rather than 25% tariff on cars. And the second point on the right here, US automakers say Trump's tariffs deal with Japan puts them at a disadvantage. So again, Trump's big strategy seems to focus on a few things: steel, aluminum, copper, and interestingly cars. And it seems that he is not coordinating quite closely enough with the car producers here, because they are claiming that now a car built in Japan with absolutely no US content shipped to the US will be tariffed less than a car made in the US, but that will be tariffed on the copper, the steel, the aluminum, and some of the auto parts as well that are used in the production of that car. So the automakers are claiming that this is the case, and it could become even more of an issue with European cars that seem to be just around the corner. So let's see if there is more lobbying to be done in Washington and if this will impact those deals in the long run. But for now, these are the deals that are said to be close. So Trump would be close to a deal with the EU as the deadline is approaching, and yeah, it's about 15%, which seems to be the new floor here. So this is the situation on trade now. Again, this is the summer; it's more calm in the market, so we thought that maybe we'd touch two maybe more wide-ranging topics. The first one is the U.S. fiscal situation. We are hard at work on the next monthly, which will be published in about 10 days from here. We're digging into the US fiscal situation and exploring why this is raising alarms. And the conclusion that we have is that the math doesn't work long term for the US fiscal situation, and we're fleshing out why. But just two charts here. On the left, you have what's the usual chart that people are looking at: total debt held by the public as a share of GDP. You always need to look at government debt as a share of GDP rather than dollars, because it's relative to the capacity of the government to tax its economy. Right now we're at about 100%, and the forecast, the line on the right, That goes all the way to 118%. This is a forecast from the CBO, the U.S. Congressional Budget Office, goes to 2035, and it shows that over the next 10 years, the U.S. could be adding about 20% to that ratio of debt to GDP based on the law as it is currently. But you can make the case that for the largest economy in the world, the economy that has the reserve currency, maybe they can afford to borrow more than other countries. So where is the limit on debt to GDP? The answer is that no one has a clue. All right. So there is absolutely no consensus on that. Maybe it's imminent. Maybe it's 20 years in the future. No one knows. But when you dig into academic literature and when you look at what the World Bank and the IMF are looking at, you get on the chart on the right, and there seems to be an emerging consensus that interest payments as a percentage of revenue is the best metric to analyze how a government is positioned to face its fiscal situation. And the dark blue line is the US. As you can see, it's higher than the others. Again, it's interest payments as percentage of revenue. According to the World Bank, and the chart goes all the way to 2023, because the World Bank, they look at every country, and they just harmonize the accounting rules over the countries to have something that is a comparable basis. According to them, in 2023, 18% of the revenue dollars for the US was then used to pay interest on the debt. So that means for every tax dollar, 18 cents went only to pay interest on the debt. For Canada, the red line, it was at 7.4%, so about less than half of the US. And when you look at the most recent data from the US Treasury Department, you find that the ratio hits about 25% now. And historically, the average country, or more often emerging countries, so again, there's a nuance to be made there, when they hit 15 to 20% interest payments as a share of revenue, that's when the problems start. In the US are now at 25%. And there's a good comparable here that will touch, and maybe that will appeal to your memory here. Canada in 1990, we were at 30% interest payments as a share of revenue. The situation was unsustainable. And anyone out there old enough to remember the budget from Finance Minister Paul Martin in 1995, they addressed the situation very aggressively. It took a toll on the Canadian economy for a few years. It was painful, but they did address those issues by doing a few things. Cutting spending quite aggressively. The spending on programs was reduced by about 10% over a few years. They set a ratio that for every dollar of taxation more that they would be getting, they need to cut $6 on program spending. Some departments, some ministries saw their budget cut by about 50%. So there was lots of layoffs on the federal government level, and it was painful, but it worked. If you look at the trend, now we're in a very advantageous situation. So the question is, for the US, is this mostly a theoretical issue? Because theoretically, the US has very low taxes. They can raise tax rates easily. Well, not easily, but they can raise taxes from a very low base and just get rid of this issue. But politically, is it doable in a country where mostly, if you're a presidential candidate, you'll be favored if you promise to cut everyone's taxes? What will it take for such an event to happen? Will it take a political crisis? Will this be created by the bond market, which is reacting and wanting a higher rate to hold US debt long term because of the sustainability of the US fiscal situation? Is this imminent, or is this something that can happen in 5, 10, 20 years? Those are the questions that we're asking. So, if you look at it from all angles, the math doesn't work on any of those angles. But after that, it's how patient will be the bond market, and how feasible is this politically by any candidate present and future in the US. So very interesting topic here. This is part of the wall of worry that the bull market is climbing. Trade situation, but also the fiscal situation in the US. So we'll keep you posted when the research is published. It should be in about 10 days. Now for equities, I use a chart on the left in the last weekly review 2 weeks ago. Just coming back to this. So now global ex-US equities remain favored. So just want to give you a picture of where we stand in the market. This is a bull market, and the market has been climbing the proverbial wall of worry, and we are seeing some decent gains this year in equities, but we are also starting to see some, let's say, full valuations in some market. In the US, the light shade of blue line on the chart on the left, 23 times forward earnings, and this is for broad indices, so it's large cap, mid cap, and small cap. So we're looking at the investable universe in those countries or regions. So 23 times forward earnings for the US, historically elevated, relatively elevated compared to other countries. After that, if you go to the red line, it's Canada, 17 times forward earnings, historically elevated as well, so it's a full valuation in Canada. After that, you have Japan at 16.3 times forward earnings, and then Europe at 15 times forward earnings. So for Canada, it's fully priced, it's elevated. For Japan, for Europe, I would say it's middle of the road. Now, when you go on the right, this is when things get interesting. For the US, the expectations for earnings growth over the next 12 months, 12% rather. So that's still a very interesting rate. But when you look at Canada and Europe, as you can see now, it's about 20% growth that's expected over the next 12 months. If you look at Canada first, you have a lot going for it. You have a more resilient than expected domestic economy. You have interest rates that were cut quite a bit by the Bank of Canada. You're seeing activity in housing in regions outside of Toronto and Vancouver. So now it's the province of Quebec, Montreal. You're seeing Ottawa, Gatineau. You're seeing Calgary as well. Those markets are seeing more action now. So it's creating economic activity. You have spending on infrastructure that seems to be coming. You have willingness to raise the defense budget, which should be again spending money within the economy. So you have the domestic economy that should be doing well, and you have expectations for growth that are higher. And also not forget gold, which is a very important sector in our equity market, where profitability is expected to be solid over the next 12 months plus. For Europe, you can make a similar story, but it's more tilted towards defense spending and infrastructure. So you have good things there. So yes, for Canada, it's fully priced, but on very solid expected earnings. So that makes that market attractive for global investors. Europe, it's not that expensive, but on very healthy and elevated growth expectations for earnings. For the US, it's expensive, but expectations for EPS growth remain also solid. So this is a bull market. We are fully invested in stocks, but we are also favoring global ex-US for geographical diversification in 2025, and that fact continues, and it's reflected in the returns that we've seen this year, as I showed earlier in this recording. So what we'll be watching next week now is going to be a very busy week. Let's first for Canada, the Bank of Canada rate decision. No change expected, but the wording will be important. Then we'll have real GDP, shouldn't really be a market mover. But in the US, you have peak earnings season next week. It's going to be very busy on earnings. And you have consumer confidence, which should be rising a bit. You have a Fed decision, of course, with the Trump administration's pressure on the Fed. Should be an interesting meeting. No change is expected. You have core PC inflation, so the inflation number that is followed by the Fed should be a bit hotter on the short end for month over month, very much stable year over year at 2.7%. You have non-farm payrolls, and you have the end of the U.S. tariff grace period next week. The deadline, of course, being August 1st. So next week is shaping up for volatility to the upside or the downside. We'll see, but it's shaping up to be a busy week, so we'll be there to comment it as usual. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content here, please share, and of course, come back again next week.